Hi, welcome everyone to CIO Series number 18, the first CIO Series of the year. I want to thank you for all of your loyal followings, and hopefully we helped you in 2024, and we aim to provide even more ideas and valuable insights in 2025. Wishing all of you a healthy and prosperous 2025. And today we have a special guest, Chris Watling of Longview Economics. Chris?
Hi, Chi. Lovely to see you. Lovely to be on.
Yeah.
Thank you.
Thank you. Thanks for joining. And I will pass on to Chris in a second. Here's some standard disclaimer on things to watch for. The session is for information purposes only and does not constitute any advice to buy, sell any securities. You need to make your own decision on whether the information is appropriate for you, and please seek professional opinion as respect to any investment decisions. A quick recap of our UOB Hian house view for 2025. You've probably seen this before. We believe the Chinese economy may very well have some upside surprise, as well as the US-China relations may not be as bad as people think, even though we see that the Hong Kong market sentiment is horrible year to date. And as you know, large cap US stocks seem to be running out of steam, and there are fundamental reasons as well as valuation reasons why we believe large cap US stocks may begin to underperform. And let's also all watch for the asset price volatility, including the cryptocurrencies, the Magnificent Sevens, US Treasuries. That could be a major source of risk in the US market. And lastly, for AI investing, our recommendation is to focus on something called Edge AI, and the key conclusion that companies like Meta and Apple will be increasingly important than companies like NVIDIA or TSMC. And if you want more details about our house view, please refer to our latest Wealth Monthly, as well as the Wealth Weekly, talk about our outlook for 2025. And if you read our Wealth Monthly, you see that we also interviewed a number of industry experts on their 2025 outlook, including Chris Watling here about Europe. But that was just a early peek or a movie trailer per se. Today we have the real deal. Again, welcome, Chris. And Chris is the CEO and founder of Longview Economics, which is a independent research firm. And he has a large number of years experience covering global markets, and have a very strong institutional background. Chris, I just saw this CNBC interview you did back in December last year, talk about Europe. I thought it's very interesting. You have a non-consensus view of Europe, which we can talk about that later. But for anyone who's interested on that, please check this link for his excellent speech. And then with that, let me turn on to Chris to introduce about your firm.
Yeah, thanks, Hugh. Appreciate it. Yeah, basically, Longview Economics has been around since 2003, so we're sort of clocking in at 21 years now. I came out of the City of London, where I was an economist and strategist, and I set up this firm because I wanted to go on and think about how to make money for people, really, how to translate macro into market views and sector views and occasionally stock views. And I always felt that economists are not very good at doing that. And actually, you've got to connect the macro to the market. So that's what we're trying to do. We think about life on lots of different time frames because some people trade, other people invest. We're based out of London. We've got clients across the globe, and they tend to be, hedge funds or institutional money or wealth managers, private banks, big financial advisory groups, high net worth individuals, family office, and the like. So, we like to know what the market's thinking. We also like to lean against it.
That's excellent. And we'll talk more about your firm and research in a second. let me start with some Q&A if you don't mind. We have lots of audience here that are very interested in China. We trade China almost every day. I saw you recently published a report called China, the Lost Decade Ahead. I thought it was pretty depressing. But we in Hong Kong are actually very interested in what the European view about China and when you think the big money will come back. So please talk about that.
Well, it's really interesting you say that. Yeah, the idea of a lost decade is sort of similar to what we saw out of Japan in the 1990s. And I think the European view, and similarly our view, and we pick this up in the US as well, is really that China's in a balance sheet recession. And just like Japan post 1990s, that is a tough decade. There's been a lot of excess in China, sorry, in the last 15 years. And it needs to be worked off. It takes a while to work it off. I'll just give you one stat. I mean, you look at the size of the banking system in China, think of it in US dollars, go back to 2010, it was a $10 trillion banking system. You look at it now, it's a $40 trillion banking system. So yeah, the economy's got bigger. There's massive amounts of credit creation that's gone into that, has created large asset price bubbles, and they are now deflating, and that takes time. Doesn't mean there aren't investment opportunities though in between, and it's not a straight line. It's worth saying that. You look at Japan, look at the Nikkei post 1990, there were 50% counter trend rallies. So the trend was down, but the market could still rally 15% as it was, in that long-term downtrend. So there's always opportunities, and China's probably an opportunity in a trading sense at the moment, but an investment sense, I think it's a tough decade, as you say, a lost decade like Japan in the 90s, and actually Europe had post the financial crisis in 2009.
What will get European institutional money back in Hong Kong, you think?
What will bring the money back? Well, I think more stimulus in the near term. European money's more inclined to invest in China than I think American money. American money now has this sort of geopolitical challenge with both the two rising, the two powers, global powers, and the sort of clash between China and America. And a lot of American money is now no longer, I'm sure you're aware, allowed to invest in China, and indeed including Hong Kong in that. But in Europe, I think it's much less restrictive. And I think if you get some decent stimulus, the problem is every time you guys are sitting right there. Every time we think we're going to get a big stimulus announcement, we get a sort of a damp squib, as I would call it. You get a taster, but not really the full meal. And the Chinese policymakers, we need starter, main course, and dessert on stimulus, not just the bread that you sit down and have at the start. So they need to announce a proper stimulus package, and that's what we're waiting for. And I think that will bring the Europeans back into the market. So all eyes on Chinese policymakers.
Got it. And we can't blame me for it. I mean, I think some of the domestic investors in China are very pessimistic too, and they are also waiting for the policy. So let's leave it at that.
The market's oversold as well. So in the near term, it's oversold. So it's ripe. Put in some stimulus in there, and you'll light a bit of a fire in the near term. So yeah.
Sure, let's leave that for a second, and we can always come back. By the way, we're going to have a Q&A right after the main session, and all of you can ask questions to Chris about China, US, or the world, or particularly Europe. Today, we're going to spend more time talking about Europe, but before that, what about the US? And to set the context, the Trump inauguration will be in 5 days. And now Bitcoin is, trading around 100,000 US dollars, and Tesla is what, like over $400, trading at 130 times price to earnings. Pretty crazy. I think the market's pretty optimistic. We are also pretty optimistic. Do you think investors are overly bullish on the US right now?
I think there's some real challenges for the US. So, for example, if you pull up, I think it's slide 18 that shows US versus Eurozone sentiment. It gives you a sense of where people are. I mean, you get this when you talk to people. You can see it here. This is the Merrill Lynch Fund Managers Survey, which I'm sure does the rounds over in Asia as well. I mean, it's a very interesting survey that gives a sense of where investors are heavily invested. And generally, the rule of thumb is when it's extreme, you lean against it and you expect it to go the other way. And you can see on the left-hand side that the overweight in US equities is at an extreme. It's sort of basically at a 25-year high. So everyone's bullish the US. We all know Trump's coming. We all know he's got a primarily pro-growth agenda. But if you go back to sort of slide 11, I would say, actually, whilst the 4-year agenda is pro-growth, we love deregulation, we love freeing up bank capital, fiscal stimulus probably later this year into next year, all great. But the point is, the first bits he's going to do are not pro-growth. They're the reverse. They're bad for growth. Tariffs are bad for growth. Obviously, cutting government spending is bad for growth. So that is a bit of an issue, I think, near term. I mean, if I add to that what we call on slide 9, we show what I call the soft underbelly of growth in the US. So there's a lot of the US economy has been really strong the last couple of years, but that's been a lot of fiscal stimulus, and it's been a lot of AI capex, basically. But under the surface, it's not really quite so good. Housing's terrible, manufacturing's flat. The labor market's not as strong as it seems. And here we've got the S&P. This is a chart of the S&P 500 earnings, and we've stripped out the Magnificent Seven. You know, the Microsofts, the Nvidias, all those guys. And if you look at the S&P 493, what's left? The earnings have actually declined for 2 years, modestly, only modest, but it's still a decline. So it's another sign there's this soft underbelly of growth. And so if you're going to tighten the fiscal, and that's, the government's been the driver, if you're going to tighten that up, that's going to expose that soft underbelly. So I think there's a bit of a slowdown coming in the near term in the US. And I think that'll feed into the economy and mean the stock markets has some challenges. So I thought it was really interesting what you said earlier about the price action in the Magnificent Seven. As a group, they're not doing that well in the last 6 months. They've lost a lot of their momentum, and I think the market's going to start to rotate in the US into other sectors, and probably initially defensive. And then if I'm right, the market pulls back in the US in the first half of the year by 10% or so, or something like that. Then you're going to rotate into defensives. Then you'll get more rate cuts priced in, and you'll rotate into cyclicals. So there's going to be a lot going on this year. A lot of sector rotation, and less of the same old. It's all the Mag 7. I think that's changing. I would agree with you on that.
Yeah, maybe the easy money in M7 is gone. And what you're saying really that the US is really a mixed picture, may not be as rosy as what the market is pricing in.
Exactly. And if you look at slide 12, which is the next slide, but this next one there. Now, I mean, this may not be very easy to see, but the right-hand side is basically the fiscal balance, the fiscal deficit, and the red line is the US. And you can see the deficit has been increasing the last couple of years. In other words, a lot of fiscal stimulus coming into the economy. If we look forwards, the red line is stable to up. In other words, no more extra fiscal stimulus. So the year-on-year is tougher. So fiscal policy is tightening in the States. And if Elon Musk gets his way, they'll be cutting government spending quick, and it'll be tighter than we think it's scheduled to be at the moment. So yeah, that exposes the weakness in the economy. You can see what's been strong, and you can see it's going to be tougher. It's like under President Biden, they were just we had 4 fiscal programs, including the Infrastructure Act, the Inflation Reduction Act, the CHIPS Act, all this stuff. And the Inflation Reduction Act is basically a green policy, and there's no doubt that Trump will stop that probably on day one. So you can see how it goes away. Suddenly the emperor has not as many clothes on as you might think, if you follow my drift. So yeah, I think it's going to be challenging. Trump talked about deportations. He's talked about reducing net immigration. Well, all those people that come into the US spend money. So if there's 1 or 2 million less, that makes a difference. So it all adds up. And I think, as I say, up front, it's growth negative. As you get a year in, it'll be growth positive. So I think there's a bit of a soft patch coming up in the US economy. which means that bonds should rally. Actually, we got a sniff of that yesterday. You would have seen the inflation data come out of the States, and that was softer than expected, and US bonds rallied, the yields came off. And that if bond yields go down, you want to buy defensives for a few months. That's the thinking.
Got it. Okay, so we can easily spend another hour on the US. Given the time constraint and given your expertise, I think let's also talk about Europe. I just have a gazillion questions on Europe because, we as a research team, we don't really have any eyes and ears on the ground there. Europe is a big economy. It's a big trading partner to both US and China. It's important, yet we don't get a lot of good insights from there. My very first question is, what do you think about this French government bond yield? I think one time was higher than Greece and people got nervous. Suddenly I got questions of whether another Euro debt crisis is brewing.
Well, yeah, absolutely. I mean, I think I find this stuff fascinating. Yeah, look, I mean, I think of it like this: what goes around comes around, and there's a cycle. And if you look at Greece back in 15 years ago, it was in terrible shape in 2009, 2010. Had a lot of debt. Had big current account deficits. It was overextended in a major way, and had borrowed too much money, and so the markets punished it for that. Now, of course, for the last 15 years, Greece has been getting its house in order. So actually, it's a really attractive investment destination. It's got a lot of good things going for it. Greece, and we'll talk about the Club Med countries in a minute, but along with all those Club Med countries. So they've had their tough time. They've spent the 15 years getting their house in order, whilst France hasn't. France hasn't been getting its house in order. It's been building its government indebtedness, and now the market is starting to question that. So to your question, will there be a Euro crisis? I don't think so, not that way at the moment. And the reason I say that is because the European Central Bank has mechanisms to control the bond spreads. And so they're not going to allow them to blow out too wide. We saw that a few years ago when other spreads started widening. The ECB steps in, controls the spreads and brings them under control. So I don't think you're going to get a Euro crisis for now. The structure of the European Union isn't set up right yet. That's a problem. That's like a ticking time bomb that may be a problem in 5-10 years time, but it's not a problem at the moment. And I think the reason French spreads are above Greeks is because Greece has got its house in order and France hasn't. So the market's just, scoring them as they should be scoring them, basically.
Got it. Yeah. But by talking to you earlier, you seem like you have so apart from this sovereign risk, there's economic risk being brewed, maybe not in France, but you mentioned something about Northern Europe. Can you give us more color on that?
Yeah, absolutely. I mean, if you there's the slide on Germany. Again, as I said, what goes around comes around. There's a long cycle in the world. There's a long cycle in Europe. And if you wind back 10 years, Germany's had a very good decade. It's been very strong. But if you wind back 20 years, Germany was the sick man of Europe. So it's like a metronome from one side to another. And now we're back at the place where Germany is the sick man of Europe again. And actually, if you think about it, it was, as you said at the top of the hour, Germany is the car industry in Europe. And of course, the Chinese electric vehicles are coming. And they're making a big difference. It's very interesting. I was in a BYD showroom in Shenzhen a year ago, and looking around the amazing cars there and the amazing showroom where they show off all their technology. And I have to say, I was with a few Europeans at the time, and the joke at the time was bye Volkswagen. As we were looking around these amazing BYD cars. And of course, that's what we've seen. Volkswagen in Germany closed one of its factories in the last few months. And I think that's the first time in over 100 years they've ever closed a factory in Germany. So my point is, Germany's got a lot of headwinds. It's had a great decade. It's enjoyed cheap money, and now it's suffering. And you can see it here. Industrial production is going down. the number of people employed is shrinking. The economy is rolling over into recession. So Germany is similar to much of Northern Europe, Scandinavia, Sweden has similar problems. Belgium's not great. And then, France has some issues that you touched on. So Northern Europe is struggling, and we think that favors Southern Europe. But yeah, Germany, Germany was built on cheap energy. You think of the cheap energy pre-Ukraine war, the German industrial base. There's a lot of car manufacturers. So now they've got the pressure of no cheap energy, Chinese electric vehicles flooding the global market. These are big issues for Germany, and they're really feeling it. And you see it in their politics. They're about to have another election. The coalition fell apart a couple of months ago with Olaf Scholz and his CDU partners, and now we've got another election coming in Europe in February. So yeah, Germany's under a lot of pressure economically, politically. It's challenged. Bizarrely, the DAX, the German index, keeps making new highs despite all that. But that reflects its global companies, not the German economy. If you look at German mid caps, they've done terribly. And in fact, I think we can see that on one of the slides. I think I'm not sure which one it is actually. Sorry, it's a bit further on. I think
too many slides, which is good.
We'll get there.
Prepared more than enough. But it looks like Germany is facing a cyclical problem. The industrial competition from China, maybe not just in electric vehicles. I see in solar equipment and in machinery. And you mentioned the geopolitical risk. Right. With the impact of energy costs related to the Russia-Ukraine war, that type of things. I buy that. And reflected in Germany's macroeconomic data.
Yeah, and it's an industrial powerhouse, as you say. I mean, 50% of GDP is exports, which is one of the highest in the major economies in the world. So a big industrial capex equipment maker, quite right. So yeah, it's facing a lot of challenges from China.
And being Germany being such a big part of Europe, does that mean overall Europe is kind of hopeless in 2025 when you have the most efficient, powerful industrial nation in Europe having trouble? Where can we find additional investment opportunities?
Well, that's the irony. It makes it look better for the southern part of Europe, which is kind of our theme, the return of Club Med, and I think you can see that on the next slide. So as bit like I mentioned about Greece. Greece has spent 15 years getting its house in order. So has Spain, and you can see in a few of these charts. There's a lot of excess in construction was very high as a share of GDP in 2006, 2007. It's now very low. The right-hand chart shows you the level of debt in Spain. This is the level. I mean, it's just the absolute level has halved. So there's a lot of deleveraging. So this is all good. So it's a very clean economy. And what German weakness means, because of course Eurozone rates are set by the ECB for Europe on average. So if Germany is very weak, it pushes down European rates. It means Southern Europe gets cheap money, and cheap money creates booms. That's exactly and that's where you want to invest. You want to invest in the small and the mid caps. In fact, if you look at two slides on, you will see the small here. Sorry, there you go. So these are small and mid caps, and I like these because they tend to reflect the real economy. The problem with large cap indices like the DAX is they've got a load of global companies in them, so they're not about Germany, they're not about Spain.
They're not pure in terms of European or domestic exposure.
Yeah, and you can see it here. And in fact, the ones that have done badly are Germany and France here. The ones that have done well are the Club Med countries. What are the Club Med countries? Just for
our audience knowledge.
Yeah. So Spain, Italy, Greece primarily, but I like to lump in. And Portugal. Sorry, you can lump in Portugal, and you can even extend it to Ireland. Ireland's not Club Med, but that island's one of the pigs, if you like. So I call it Return of the Pigs / Club Med. Club Med is literally the countries around the Mediterranean Sea, which is Spain, Italy, and theoretically France, but I wouldn't include France in this. But I'd include Portugal, I'd include Greece, and include Ireland even. So they're doing very well. Spain's one of the fastest growing countries in the in the sort of, certainly in the G7 and one of the faster ones in the G20. So, and you can see the mid-cap indices are doing terrifically. And in fact, I think we've got a chart on the banks in some of these countries as well. If we go back one slide, isn't it? We're on slide 16. There we go. So there's your Italian banks, there's your Spanish banks. And don't forget, I mean, there's 3 or 4 big banks in each of these indices. They dominate this price action. So, you know, take a look at the banks underneath the surface, and I think you'll find the price action of most of them is pretty good, and those are the ones you want to go for. So these indices have done as well as any of the Mag 7, if not better. So they're good
stocks.
It looks
like a Mag 7 chart. It doesn't look like a European stock chart.
Doesn't look like a European chart. No, it looks like a Tesla chart.
Yeah. So for the record, your top pick is Spain.
Yeah, from a country perspective, we
number
like
2
Spain.
country. What about number 2?
Well, I like Italy. I think Italy's really interesting.
Okay.
Yeah, we like the UK, but we're going to talk about the UK, I think. But
UK, wow, but that's outside the box thinking. And then number 3 is UK.
Yeah, we like the UK, and we like also, I think US small and mid caps are going to do well. So back to the idea of rotation.
I'm talking about ranking within Europe.
Ranking within. What's that? Sorry.
Ranking within Europe will be a number 1 pick, number 2 pick, and number 3 country-wise in Europe.
Well, Spain would be number 1. I'd probably Greece is probably number 2, and then sort of UK/Italy.
Got it. Okay, we can go any direction you want. You want to talk more about Italy or UK? UK would be interesting to us because Hong Kong, UK always have a very strong connection.
Yeah, let's talk about the UK. So if you look at slide 20 is where we can tee it up, and then we can drill down from there into which bits to buy, but start with the macro. Yeah, I mean, here's the thing. Every 18 to 20 years in the UK, you get a consumption boom. And in fact, you tend to get the consumption boom at the same time in the US and the same time in Southern Europe. And it coincides with the household getting more indebted. That's what you see on the left-hand chart, household debt to GDP. And you can see when it expands in the noughties, 2002, 2007, when we had Tony Blair and Gordon Brown in charge, we had a consumption boom. And then under Margaret Thatcher in the late 1980s, we had a consumption boom. And then we had a small one in the mid 1970s. And what you can see is you look at the household debt to GDP, it's contracted sharply over the last 15 years. So in 2009, it was about 100%. Now we're sort of down high 70%. So people have been feeling pretty gloomy in the UK for a long time, really, since 2009. We had Brexit in 2016, you'll remember. That made people feel more gloomy. Then, of course, we had the pandemic like everyone else. And it's been a tough economy. But I think now we're starting to cut interest rates. And the Bank of England's already cut rates by, about, I think, 75, 100 basis points. I think they'll do another 100 at least. And they're going to keep cutting rates. And what that always does is it starts to turn this chart upwards. People start to borrow money. They buy houses. You get a wealth effect. They feel better about life when house prices are going up, and you get this consumption boom starting to brew. Now, we're also in a place where the banks in the UK are desperate to lend money. So Lloyds, I always like to talk about Lloyds Bank. Lloyds Bank is, one of our 4 big banks. Most of its loan book is lending mortgage debt. So once the housing market starts going up, it starts lending a lot of money. It starts making a lot of money, and its earnings growth starts improving. And Lloyds Bank's a really cheap stock. Last time I looked, it was 8 times forward earnings. A year ago, it was as low as 5 times forward earnings. It's like an abandoned stock. Everyone has given up on it because it's had 10, 12 years of this chart going down. So if it starts going up, it's going to start making money. And really, if you look on the next slide, we call it a new cycle is dawning. It's been 15 dire years, but there's a whole powerful combination of factors coming together that's going to drive a really strong growth phase for 2 to 4 years in the UK economy on the consumption side. So, Banks, as I said, banks got a lot of capital. They want to lend money. People haven't borrowed. They've deleveraged. As rates come down, they want to borrow. All the ingredients are there. And if you look at how much money people have in their house, how much housing equity they have 7 trillion pounds in the UK, which is equivalent to 2.5 times GDP, and which has more than doubled in 15 years. So it's huge amounts of housing wealth waiting to be tapped and spent on the high street, and get that feel-good factor back and get people feeling good. Now, and I think that's plausible. People worry about our new government, and we can talk about that if you like, but I don't think that's going to derail the party. I think it's going to be a good few years. People are desperate for it, and rates coming down and house prices going up should deliver it.
That page 20 seems to me a re-leveraging story. Am I right?
That's right. That's the re-leveraging story.
Also stimulating debt growth and consumption growth.
Exactly.
That's interesting.
Exactly. Credit cycle.
Credit cycle. Let's talk about stocks. You mentioned, just stay in the topic of UK. Maybe we can expand to broadly other European countries. Within UK, you talk about Lloyds Bank. What about HSBC?
Yep. Well, HSBC it's a different beast, of course. It's not something I'm terribly close to, but of course it's very exposed to global markets, and particularly Asia and China. So it has a slightly different mood to it than Lloyds. Lloyds are a very pure domestic UK play. But having said that, I still think it's an interesting bank. I think as yield curves steepen up, banks and financials globally are interesting places to be. I mean, you've seen like the US banks do so well in the last couple of years, and I think that can continue. We're starting to steepen up the US yield curve. When you steepen that one up, you'll steepen the UK and the European one. They all move together, and that's a good environment for big banks. So generally, we like banks. HSBC, as I say, I'm not a banks analyst, so I follow Lloyds quite closely because it suits our story. But yeah, I'd suggest most banks are interesting on the Western side.
Yeah, the yield curve in the US finally has turned normal, upward slow shape. I think was like a month ago. So that's finally benefiting the banks. So people normally associate the interest rate cuts or rise, but really it's the yield, the shape of the yield curve that affect the bank earnings. And we're already seeing that, by the way. JP Morgan reported good results this week. We're expecting more bank results out of the US, and we're seeing very strong momentum actually behind all the US banks. And like you said, maybe we'll see the same thing with the UK banks as well. And it seems like there's a interesting story. Okay, before we wrap up, we go into Q&A. Are there any specific sectors or stocks that investors should look at based on what you discussed, the themes out of Europe?
Absolutely. I mean, as I said, I'd be for the next few months. It depends on your time frame. For the next few months, I'd start thinking about moving a little bit defensive into the first half of this year. But if you're looking 12 months out and beyond, I'd see any pullback in the market as an opportunity in the global stock market. I'm talking about, particularly the Western one. I'd see that as an opportunity to move into cyclically sensitive sectors in Europe. So you could start at the top level mid caps in the countries we mentioned, Spain, Italy, Greece, and the UK. Then you could boil it down to things like you could look at UK home builders. They've been kind of beaten up recently. The likes of sort of Taylor Wimpey and so on. Actually, similar to US home builders, they've all been beaten up as yields have with KB Homes in the States. But actually, I think the housing market's going to do very well on a 12 to 18-month view. So home building stocks, UK, US, very interesting. I think consumer cyclicals in Southern Europe, in the UK, very interesting. And a lot of those stocks haven't done that well. They're waiting to us. Then they should respond to rate cuts, but and that's what I think we'll start getting more of. So all of those areas, and the banks, of course, we touched on. I also think some of the commodity stocks might do well. I think commodity prices, once we start pricing in more rate cuts in the first half of this year, commodities should do well as well, particularly, the likes of copper, some of the rare earth plays that you see out there, some of the diversified miners, they're pretty beaten up. So what I would say is I'd look for defensives first half of the year, and then into the weakness, look to go cyclical into those names I just mentioned.
That's interesting, because I don't want to seem like we kind of colluded before this, but we've been saying the same thing. You know, defense before offense. We had already a very strong performance at S&P 500 2024. I don't think there's a rush to getting to anything right now. So year to date, even though just a few trading days, all we've been pitching are the high dividend yield ETFs. You know, buy stocks for yields, buy shorter duration bonds to avoid the interest rate volatility type of things. And one last question, before I turn over to you to talk more about your firm and services, is again, it's a very hot topic, is on the Fed. You did talk about the Fed rate cuts, but today seemed like the market scaled back the expectation for the rate cuts. Even, you know, some people even say there may be no rate cuts this year. What's your thinking on that?
Well, if you could pull up slide 13 very quickly, I can talk to that, because it strikes me in the last couple of years the markets have been, as I call it, sort of tossed by the waves. You know, there's a lot of indecisiveness, and I think it may reflect the fact that post-pandemic the world hasn't behaved as it normally does. The usual playbook hasn't quite worked out. But this chart I'm showing you here is basically what the market thinks Fed policy will be at the end of 2025 and the end of 2026. And the chart goes back to early 2023. So it's a couple of years of history. And what you can see is it's up and down, up and down, up and down. It's sort of moving in a 150 basis point range. So in other words, I would take what the market thinks with a pinch of salt. And what it does is it provides opportunities. And I think the market's as confused as the Fed. And I think we need to price in more rate cuts. We've priced out too many rate cuts in the last few months, and we need to price some of them back in, because the economy in the US is not as strong as it seems. So I think that's what we'll see from the Fed. We'll see a change in its language over the next few months, and maybe it started yesterday with that CPI data point.
Yeah, especially if you expect economic risk in the US, then I think there might be more rate cuts than people expected this year.
Exactly. Yeah, me too. That's our view.
Great. Before we go to Q&A, maybe a few minutes on your firm and what services you offer. And also, I understand you'll be coming to Asia over the next few weeks, and we see if we can do something around then.
Yeah, exactly. Yeah, we're in Asia from the 9th to the 15th of February. So, yeah, that would be great. We'd love to hook up with people that are interested and talk in more detail. But, you know, if you go back, say, one or two slides, we like to think in terms of 4 cycles. So I think what makes life confusing in the world is people talk about really bearish things every time the market moves. You've got to disentangle the short term from the long term. You know, the long term debt super cycle, the debasing of the dollar, the geopolitical battle between China and America, the long cycles of history, very interesting, fascinating. We love thinking about them, but they shouldn't influence one's investment and trading timeframes. So we kind of divide all those timeframes out. We can see it here: the long-term structural, the strategic business cycle, which is classic global asset allocation. B, where do you put money in the world? Should you be in China? Should you be in the American market? Which bonds should you buy? Which commodity? Do you want to buy gold? We think gold's interesting here, actually, et cetera, et cetera. And then shorter term C and D, if you're trading these markets, it's much more about fear and greed, risk appetite. We spent a lot of time analyzing risk appetite. So, you know, that the next slide is kind of gives a bit of a summary of that. The 4 different cycles, the very long term, and so on. And we offer different publications to reflect that. So we have a global asset allocation publication set. We have a tactical and trading set. We have a sort of long-term thinking set. So we sort of divided it out. Some people like it all, most people like a bit of it, you know, and so on and so forth. So yeah, the wonderful thing is we run around the world talking to different investors, very smart investors. They question your thinking. This is what I love about financial markets. The financial market, you got to be right because you got to make money. So if you're wrong, you're quickly found out.
And the market
so yeah,
all the time.
What's that?
The market gives you valuable feedback all the time, and that's something interesting too. This hopefully we can leverage you more in the future. Is when you talk to this big smart money, and we'll be very interested in knowing not just your view, but also their views and what they are thinking and doing across the world. And it looks like you, as a firm, you offer not only long-term thematic research, whether it's for asset allocation or long-term investing, but also have short-term trading, signal models, that type of things. Am I right?
Exactly. Yeah.
Okay.
We do all of that, and it's a lot of fun.
And Chris will be back in Asia, in Hong Kong, Singapore, from February the 9th to the 15th. So if you're interested in having a deeper conversation with him, please contact the firm directly. We will also likely host something with him in our UOB offices in Hong Kong and Singapore if our sales and clients are interested. So stay tuned for that. So with that, let's go on to Q&A. If you have any questions, please use the text window, the questions window, to enter your question in text as usual. Any questions on anything we talk about today? Mainly, let me recap the European perspective on China, on the US, and also bulk of today's content, it focuses on European outlook and strategy in 2025. While we're waiting for the question, I have a client question for you, Chris. Is again, it's a very corny question, and I almost ask every guest: is what do they think about India versus China?
Yeah, great question. I suppose, you know, off the bat, you would say India is the expensive markets, China is the cheap one, and there's no doubt about that. And I think in the last few months, India has become a bit of a funding for the sort of flurries we've had in the Chinese market. It's become a funding market for asset allocators globally. So they've been selling, they've all been big into India for many years and nibbling on China when we've had the stimulus announcements. But in terms of the sort of macro, I always think the obvious big picture distinction is that in China, there's no issue with the supply side of the economy. What do I mean by that? I mean building stuff, building roads, opening factories, creating industries, and so on. Whereas whereas actually, in a sense, the challenge is demand. Whereas in India, it's kind of the other way around. The demand is there. It's a very young population. They're desperate to spend money and make money. But there's natural growth there. But the supply side is sticky and a lot of challenges, very hard getting stuff through. So that kind of creates a different dynamic. But actually, I think as China has a lost decade ahead of it, as we talked about, I think India has the opposite. I think it has a good decade ahead of it. And what we've seen with Modi is really pretty good for strengthening the country's outlook and economy. So at the moment, India's been quite expensive. It's suffering a little bit from that. But in the medium term, it's a very interesting place to put money.
Got it. Okay, our first question is asking us to clarify about the U.S. Investment restrictions in China. Yes, there are U.S. restrictions in China. I'm not sure you participated in our CIO Series 2 webinars ago when we invited the ex-portfolio manager from Ontario Teachers Pension Plan. Now, whether it's Canada or US, we're seeing increasing restrictions of government and state investment restrictions into China, whether it's broadly or within specific sectors. So that's definitely happening, has happened. There are stocks like China Mobile and certain Chinese tech names, SMIC, are on a restricted list or blacklist, not only for doing business, but also for investments. So if you want more details than that, we can follow up on that. So that's really happening versus what Chris said earlier, that in Europe, we don't really have that much, that kind of problem. Am I right?
Yeah, absolutely. And I'm really talking from the perspective of speaking to clients, our clients and people we know, and the challenges they do or don't face. So, you know, I'm not an expert on this. I'm simply passing on what I hear. But yeah, definitely in the US, there are companies that manage global equities that a lot of their money comes from the US. It might come from those big pools of capital you mentioned, like pension funds or government state funds and things like that. And they have restrictions, and they have to carve out of global equity markets. They have to carve out the Chinese piece and avoid that when they're managing those people's money. So it is an issue, but that's where we sit basically.
Got it. There's a question on AI. I'll be really brief about this because today's topic is really not on AI. Last year, AI theme is more on front end. I think maybe we mean is the back end, right? The infrastructure, such as chip design and manufacturing, NVIDIA, which is the core for AI GPUs. Do you think 2025 this will bring NVIDIA to the next higher level prices, or this AI thing will shift to other companies? Yes, we'll definitely be shifting other companies. Please follow our research. We've been saying this since mid-2024. I probably said this a dozen times that the focus is increasingly shifted to something called Edge AI. Again, no time to explain the whole thing today, but please look that up. Edge AI, we've been written multiple reports on this, and what that means is the focus will be increasingly shifting from the back end, the infrastructure, the model training side to more applications, especially applications on local devices, especially applications on wearable devices. That will be the major breakthrough for AI applications. It's not just simply your smartphone, but smart glasses, which will integrate with your body and have vision to see what's around you. That is very critical for the next stage of AI. So that's why we've been saying that going forward, Meta and Apple will be more important than NVIDIA. NVIDIA's fundamental will remain strong, but the further upside will be along the line of those companies. And Meta right now is our #1 pick, not only in AI, but also Magnificent 7. The second question, I think it's really to you, Chris. What do you think about the rising 10-year Treasury yields? That's another hot topic today. Where's the top? And how do you see that play out?
10-year Treasury yields, yeah.
10-year Treasury yields at 5% almost, yeah.
I think we've either had the top or we're very close to it. So if you look at Treasury bonds, they're deeply oversold in a way they rarely get, and that's a good indication that the price has fallen a lot and the yield is up hard, and it's starting to bite the economy. You know, you can see that housing's on the floor in the US because of higher bond yields. There's an impact on growth, so there's a feedback mechanism. And everyone's bearish, and these are good signals that you want to be the other way. When everyone's bearish, you want to be bullish. When everyone's bullish, you want to be bearish. And at the moment, everyone's bearish on bonds. So yeah. I think the yield is near the top. We're quite near the highs from October, which were just below 5. And I thought yesterday's CPI was interesting in that it just questioned that narrative that inflation's really sticky and bad. I don't believe that. I think inflation is under control and trending down. So
plus,
I'd be nibbling at bonds here.
Right? So if we believe what Chris just said about the soft belly of the U.S. economy, if that started to show as Trump administration withdraw the fiscal policies, that will definitely get the yields down.
Exactly. Yields growth can go down and inflation can go down, and both of those would encourage yields to come down as you price in more rate cuts, basically.
Yes. How do we know if European funds are investing more into China instead of selling out? what signals or data to look up. That's a tricky one. I don't so far we have not seen any reliable tools to track, particularly money out of Europe. Maybe there's some anecdotal evidence that you can use. Chris, any thoughts on that?
What was the question? Sorry, I lost you there.
Are you getting
What's
more or
the
less?
question?
Huh?
What's that?
How do we track the European?
More or less what?
How do we track the European flows?
European flows?
Yeah. European money flow.
How do you track it? I've not found a good way of tracking it scientifically, but I'm sure there is one. But certainly anecdotally, we talk to a lot of people in Europe. We can track it that way and keep you posted. But in terms of actual flows, I haven't seen. I'm sure there is data somewhere, but I haven't seen it.
How about this? Entering 2025, are you getting more questions on China versus 2024 this time last year?
No, we had more last year. There was more excitement about stimulus possibility last year than there is this year. This year, people aren't talking about it now because which is a good sign because it means that it can go up. If no one's talking about it, there's no money in it. If everyone's talking about it, they're either about to put money in or they put it in. So, yeah, I think, I'd say much more last year. I think the market over the last 12 months, the market has become settled. The smart money market has become settled in its mind that China's in a balance sheet recession, and it's been disappointed about stimulus announcements several times. So it's it's gone off its radar. People have stopped worrying about it and thinking about it. But I think that's normally the time when you want to be thinking about it because that's when the opportunity arises. So I'd say much less questions now.
Make sure to call us first if you see any action out of Europe into China.
Yeah, I will do. You bet. First call.
Quantum computing, we're going to skip. Apologize for that. Today, let's focus on the European perspective. Chris, any thoughts on the European luxury sector? This is a sector that, by the way, Asian investors are quite familiar with because Asian consumers are probably the biggest consumers for these type of products like LVMH. Or Gucci or Prada. Any view on that?
Yeah, I mean, look, until you unlock all the cash in bank accounts in China and get people buying a lot of luxury again, these are stocks where all you want to do is trade them for a bounce. So I wouldn't get stuck in again. So I'd be cautious on. I think the price action in LVMH doesn't look very good. Looks like it's in a downtrend to me. So trade a bounce if you want to, but wait until we get more stimulus, more focus from Chinese policymakers on getting consumption going and getting all that cash in Chinese bank accounts spent on luxury goods. So I'm not a fan of those stocks at the moment. They had a great run. I just think you need a change in mood to get them properly going.
Yeah. So my 2 cents on that is that if the Chinese Asia market or Hong Kong market had a sustained rally, that were actually good for the luxurious consumption in China. There was an interesting article recently in Chinese on the Chinese internet saying whether the stock market can save consumption. The conclusion is that it's not going to save general consumption because every Chinese bull market generally leads to more wealth disparity. The rich get richer and the poor get poor. So as the rich get richer, I think we will see a revival of the luxurious spending in China. Until then, I think there's going to be struggling like the Chinese economy. So here's a good question on the policy, Chris. You said earlier that European investors, including yourself, are waiting for policy from China. So specifically, if there's anything you're looking for to turn more bullish on China, policy-wise, is it like a dollar amount?
Yeah, we're looking
for policy you're looking for.
Yeah. I think there's two kinds of policy. One that you might well get, and one that you probably won't get. But the one that you might get is more fiscal stimulus that encourages consumption. Anything that encourages consumers to go and spend money. And we got a feeling we were going to get some of that a couple of months ago, but it didn't really come through. So that would be good. Look for more fiscal. That would be encouraging. on the consumer side. The thing that I don't think you'll get that would be really good is if the housing market was allowed to clear and people took their losses and you cleaned up the system and you did a bit of it like America did a top in 2009. You did that in China. I don't think it's going to happen, but if you did, that would be long-term very positive, but it would be short-term very bearish. But I don't think that's going to happen. So focus on number one, look for fiscal. That should bring a rally, a counter-trend rally back in the Chinese market, which could last 6 months. It's perfectly plausible. You could get quite a good move.
Infrastructure spending or consumption stimulus?
I'm sorry. Consumption stimulus, yes. Sorry, the connection is not very good. I don't know. Right. I don't know what that is. It may be my end.
Any specific fiscal policy that you're referring to?
Yeah, fiscal policy, consumption spending, focused on getting consumers spending money. That's the fiscal policy you need. It could be all sorts of things, discounts for buying goods. In Europe, we talked about negative interest rates in bank accounts. I doubt you'll get that, but that is to encourage people to spend money, stuff like that. Anything that encourages consumption would be good.
Got it. There's a question
it's demand that's the problem in China. Yeah, go on, sorry.
There's a question on the crypto scene in Europe. I'm not sure you know anything about it. If not, we don't have to talk about, but if you have anything to say on that.
Oh yeah, people love crypto. They're mad for crypto. I personally am not totally convinced, but I can understand why it's going up. Obviously, the Bitcoin reserve that the US government's talking about is exciting people. But the reality is, I still think it's got. I can understand why people play it, and I understand why it exists because of the debasement of currencies and the way the monetary system is run. But I still think it's a bubble, and I don't think it'll last forever. I think there's some real issues. Just look at how many coins there are. I mean, that's a classic sign of a bubble when you get a massive amount of supply in the new thing. And of course, that's what we have now. We have several thousand coins, and some of them with ridiculous names that I won't repeat on here. So Bitcoin's had a good run short term. It's giving back some of those gains. I wouldn't hurry to buy it here. I think it needs to deflate quite a bit. And then if you like to speculate in it, then give it 6 months and it might be where you want it to be, considerably lower, and that could be a good entry point. But yeah, I wouldn't chase it here.
You mentioned earlier that you're bearish on Germany, partly because of the Russia-Ukraine, the geopolitical risk. How do you see that play out in 2025 under Trump? The Russia-Ukraine conflict. Chris,
I'm so sorry, Chi. The connection is yep. Ukraine, something on Ukraine, far away.
Yes,
sorry.
The Russian-Ukraine war as putting downward pressure on both the German economy and maybe the stock price. But what will be the outcome, you think, in 2025? Will that be alleviated?
I think we've got a taste already of what Trump intends to do. I thought the ceasefire announced in Israel with Hamas is a direct result of Trump's threat in the last couple of weeks to all hell break loose, I think in quotes was what he said, if the hostages aren't released. So I think he's very anti-war. We know that. We can see he's already made a difference. And I think you'll get a peace deal in the Ukraine with Russia. Exactly how, who knows? But that's good for confidence, and it adds to the growth outlook in Europe, basically. The other thing that'll be good for Europe is Trump's going to force them to spend more money on defense spending, so you get more growth that way as well. So I think that I'd expect a peace deal, and I think it's positive for Europe.
Okay, the connection, unstable. But I have one last question, Chris, if you can hear me, which is, will Trump's policy, and this is from the audience too, kind of push Europe more towards China so that China will work something out with Europe, trade-wise and economic-wise and political-wise? Would Trump intentionally or unintentionally push Europe closer to China?
Yeah, it's a very interesting question, and I think it's, Europe loves to be in the middle and has to be in the middle because it has such a greater dependency on China than the US does. So I think they'll try and play both sides. It'll be interesting to see whether they can achieve that, because Trump is, of course, going to threaten them with tariffs, and part of the tit for tat will be that Europe faces more towards the US and more away from China. But I don't think Europe can disentangle itself from China. So that's going to be a tough gig for Europe. I think it might push Europe to generate more of its own growth. We've had this famous Draghi report out in the last 9 months, about how Europe can increase and supercharge its growth. And it will probably encourage the Europeans to do more of that and get more engaged in looking after themselves and building their own defense industry, building more of their own energy industry and that sort of stuff. So, yeah, I think Trump will mean that Europe has to work harder to face both ways, basically, to both China and the US.
Got it. Okay, we have to stop here. We're at the hour. Again, thanks everyone for dialing in. And also thank you, Chris, for your valuable time. I know you're a very busy man, but you are going to be in Asia again in February. So for people on the call, we will likely hold a in-person event with Chris in both our Hong Kong and Singapore offices. If you're interested, please contact your UOB Kay-Hian representative, or if you want to meet Chris directly, please email this email address on your screen. We will make today's webcast available as a replay on our UOB Kay-Hian website. I want to again thank everyone for participating, and thanks, Chris. Hope to see you soon.
Thank you very much. Appreciate it. Thank you.